Hi, welcome to KiwaniTalk. We're a public information program put together by the people from the Dearborn Kiwanis Club. We are on location with the equipment provided to us by the Dearborn Cable Commission, and we're very excited to be on the road at the Friends for Animals of Metro Detroit. I want to call it the Dog Pound, but it's not a dog pound. It's a beautiful facility, recently opened, and if you're interested in any kind of a pet or adopting a pet, cat, dog, they're here. It's in Dearborn, behind the Dearborn Court, behind the Dearborn Police Station. Come on down to the Friends for Animals of Metro Detroit and take a look. It's a wonderful facility, but we're not talking about dogs and cats today. Today we're talking about death and taxes, and mostly taxes. And those are things that are a big issue for all of us. There was an announcement recently by the president that there's going to be a massive tax increase, he says, on the rich. It may trickle down to other people, but talk about taxes, and more importantly, how to avoid them as opposed to evade them, which is not legal. We have Jerry Assenmacher from Assenmacher and Associates, CPA, member of the Kiwanis Club. You've been there as long as I have, Jerry, which is since Moby Dick was a minnow. And
we joined the same day?
Same day. So welcome to the program, Jerry Assenmacher.
Hi, Gary. How are you doing?
Great, Jerry. You're a CPA, and how long have you been working as a CPA?
I've been practicing for 35 years.
Okay.
Started out, the original firm was in Dearborn Heights, Rennie DeBolton Company. I became a partner about 7 years after starting there. Eventually, the partners departed or retired, and I ended up on my own. And my office currently is located in the Dearborn Area Board of Realtors building on Monroe, just off of Outer Drive.
Now, I want to say this in the kindest way I can. Like, really, taxes? But to some people, it's exciting. And,
oh, absolutely.
And I had a secure transaction professor in law school, the driest subject you ever want to have, but he got going on circular secure transactions and how perfected security interests go. And when we talk about taxes, that light that went into my secure trans professor's eyes, same lights in Jerry Assenmacher's eyes. So let's talk about taxes.
Well, you know, I wanted to focus the first part today on talking about what's going to happen or what you should be doing between now and the end of the year. And one of the big, a couple of the big changes this year that came into light in 2020, as of right now, don't exist. And one of them I definitely believe is not going to change. And that is people that are required to take a required minimum distribution, or we call it an RMD, from their IRAs. That's anybody who's 72 years or older are required to take an RMD from their IRA. They didn't have to do it in 2020. And the thinking was that once COVID had hit, there was this fear that as they shut down all the businesses, that people's IRAs were going to, value-wise, were going to tank. It happened when the market crashed back in 2008, and a lot of people were taking out money based on depressed dollars. So they said, you know what, no required minimum distribution. That is not the case for 2021. You must take a required minimum distribution. You should be talking to your financial advisor. If you don't have a financial advisor, then there are tables that you would compute how much you need to take out of your IRAs. But that is, again, for only somebody who's 72 years or older.
Talk about the problem with doing do-it-yourself RMD analysis, because the cost of a tax advisor or a financial advisor versus the penalties and the interest that you get by messing up your RMD. Is it worth it to do yourself?
Well, first off, if you don't take the required minimum distribution, and again, that's all based on tables, and I'll just give you an example. When the year you turn 72, you have to check to find out what the value was of your IRA 12/31 the year before. So in our case would be 12/31/2020. If that was worth $100,000, then you have your multiplier, I believe, is 25.6. So you have to take that $100,000, multiply it by 25.6, and that is, or in this case, that would be 25 but you divide that by the 25.6, and that is going to end up being the amount that you have to withhold. I mean, you have to take out of your IRA.
So out of $100,000, that would be.
And I said divide, I meant multiply.
Multiply. So so 0.256.
Yeah, you'd have to take about 20. You know, it's 0.25. You'd have to take about 25 grand. And I think I'm a little off on those that calculation. But
so here's the thing. Here's the guy who's an expert in this area.
Yeah.
He's looking at the tax tables, and let's say you're off by $10,000.
Right.
What's it going to cost you for penalties?
Yeah, you have to divide. You have to divide the 100,000 by 25.6.
Okay, so $4,000.
So about $4,000 every year. That percentage goes down. Those tables go, believe it or not, to the age of 115.
Okay.
At 115, you only have to divide it by 1.9. You know, so
that's pretty good.
They're kind of ridiculous as how far they go. So, but they do go to age 115. So if you're doing it yourself, and you have more than one IRA, you've got to do that calculation for every single IRA.
And if you screw up, what is the penalty?
Penalty is right around, I believe, about 5% of the underpayment for every year until you fix it.
So it could be a lot of money. So
could be a lot of money.
Financial advisors come in all
Yep.
sizes, shapes, and flavors and cost structures, but certainly think about consulting one, because not only can they give you advice as how to avoid penalties, they can give you advice as how to structure things to avoid taxes too.
Now the other part of the IRAs too, and it's becoming a bigger and bigger thing, is because IRAs, you know, 40 years ago, they were just starting out, but they're becoming a bigger thing now. So I call it my generation. We generally all have IRAs.
People try to put us down.
The other problem with my generation and a little older is we're dying. And our children, our nieces, our nephews, or whoever are inheriting.
Or the Metro Animal Shelter.
We're inheriting those IRAs. And it used to be that you can take that IRA out of over your lifetime. That law changed 2 years ago. And now if you inherit an IRA, unless it's your spouse's, you must take all that money out within 10 years.
So the RMD is different for that?
All they say is it's all got to come out in 10 years. You can elect not to take a penny out for 9 straight years, but you got to take the entire amount out in year 10 then. Or you can split it up 10% every year, but you must take it out unless you're the spouse of the person you inherited the IRA from.
Now, there's IRAs and there's IRAs. There's regular IRAs and there's Roth IRAs.
Yes, Roth IRAs, this is just traditional, as they call traditional IRAs.
Okay, but how about we talked before the show, and we want to get into is about some kind of a back-end Roth IRA.
Well,
what's the deal with that?
That's something that's right now, a back-end Roth is, there are income limits. If you're covered under a 401k or on any other type of retirement account, if you hit certain income levels, you are not allowed. I'm going to say it's about $150,000 for married filing joint, maybe about $100,000 for singles. You are not allowed to fund a traditional IRA that you can deduct.
Okay.
So I'm somebody making $500,000 a year.
I need to borrow some money, Jer.
What's that?
Oh, it's just an example.
Yeah,
okay.
believe me, that isn't me. Gary's making $500,000.
Gary wishes.
Gary funds his 401k to the maximum, and at your advanced age, that's well into about $26,000 a year. You also fund a traditional IRA, but you put it in as a non-deductible. So you fund it, you don't get a deduction on your tax return. The day after, or the week after, or the month after, you convert it to a Roth IRA.
Okay.
All the growth for the rest of your life is tax-free.
So you take the bite at the beginning of it, but how much can you put into it? How much can you put into it?
You can put $6,000 plus the geezer rule, which you qualify for. That's anybody over the age of 50. They can put an additional $1,000, so they can put $7,000 away.
$7,000. Then you can convert it automatically to a
And
Roth.
just convert it to a Roth. Now, I know some of people who are in their early 30s, even their late 20s, that are making a very nice, handsome amount there. They're above that 150 level. They're funding their 401k. They're also doing this contribution. And can you imagine and they're only 6,000 because they don't get the geezer rule, but they're putting $6,000 into this IRA and converting it to a Roth every year the day after. At age 27, by the time you're able to start drawing on that after you're 70 years old, that number could be incredibly, or you could start actually at 59.5. That number could be incredibly high, 100% tax-free. As of yesterday, the House Ways and Means Committee.
So right now we're sitting here on September 16, 2021. So September,
As of yesterday, the House Ways and Means Committee says on the next tax law that's going to come out, their intention is to kill that. They don't, because there's one gentleman in particular, I believe his last name is Thielen, and he has accumulated, they said, in excess of $5 or $6 million.
And that money belongs to the government, and they want their money.
Well, it actually, the way it is right now, he hasn't done anything illegal.
I know.
But they want to put a stop to it.
I want you to notice, folks, when Jerry was talking about this backdoor IRA, his eyes were sparkling, and when he talked about it being killed, the gleam went out.
The other thing I want to talk about today is something that a lot of our younger viewers might have experienced, and that is starting approximately July 15th. If they have children that are 17 years or younger, they started getting checks. Minimal amount was probably about $250. It could have been higher depending on how many children they have between newborn and 17. But this is President Biden started this. This is the Advanced Child Tax Credit.
It's a gift from the government, right?
Well, starters, they increased the child tax credit from $2,000 to $3,000 in 2021. Then if the child is under the age of 6, the child tax credit went up to $3,600, as long as your income is under $150,000 married filing jointly. So they started to give you this money once a month for 6 months starting in July. So you're going to end up getting half of your child tax credit. You don't have to pay taxes on it, but you're starting to get that child tax credit. Here's the problem with it. You have 2 kids. You're getting, your kids are over 6 years old. You make in excess of $150,000. You don't qualify for the $3,000 level. You still get the old $2,000 level. They're going to turn around, and last year on your tax return, you were able to take $4,000 off of your bottom line of what you owed the IRS.
That's a tax credit. Okay.
This year, you're only going to be able to take 2 because they already gave you the 2.
Right. So, rule number 1 from the government: nothing is free from the government.
Well, it's free, but you got it in advance. So there's a lot of people that purposely under withhold. They got 2 kids. They were getting this $4,000 credit on their tax return. They under withheld throughout the year, but they knew that when it came down that they owed $3,000. They knew they had this credit coming for 4, and they got $1,000 more back. Guess what's going to happen this year? They owe the 3. They've already gotten 2 of the 4.
It's like Gomer Pyle on
so
the show.
So they're going to owe $1,000.
Like Gomer Pyle would say, surprise, surprise, surprise. But we're going to have a surprise right now. We're going to surprise. We have to take a break for a second. Right. But we'll come back and talk about it. We'll get the gleam back in Jerry's eyes. We have some words here from Kiwanis talking about our club and about other things going on. And we'll be right back from the Metro Animal Shelter here in Dearborn. I'm Gary Gardner with Jerry Assenmacher, CPA extraordinaire. Don't go away.
There must be a lot of love out there in the world, at least if you think of all the things people say they love. But it's funny. Sometimes the things we love the most are the ones we don't talk about often enough. I mean, the things that bring true change to a child's life, to a community, to the people who come together and make change happen. Think about what you love about your club. Think about the children it reaches. Think about the pride it gives you. And think about this. Thousands of Kiwanians around the world love being members of their clubs too. So think about what could happen if we all shared our Kiwanis stories. After all, there's a million things to love in the world, but there's nothing like a love that makes the world better. So show it, share it, let the world know.
Welcome back to KiwaniTalk. My name is Gary Gardner. I'm your host for this episode, On the Road with Kiwanis, and we are here at Friends for Animals of Metro Detroit. We taped the show here earlier. Thank them for letting us continue our broadcasting from this wonderful facility. It's here in Dearborn, behind the Dearborn Police Station. They're a great organization. Come out, find a pet, take him home or her home, or if it's been neutered, it home. You'll love it, and it'll be part of your family forever. We have something, it's not an it, it's a CPA. It's Jerry Assenmacher from our Kiwanis Club. Death and taxes, unemployment, go.
All right, one item that I didn't talk about in the first half that I wanted to bring up, and that has to do with what's happening here for 2021. And that is for a lot of individuals who earned under $150,000 last year, up to $10,200 of their unemployment was tax-free. A number of those people continue to collect or did continue to collect unemployment into 2021. The government has not said anything about making it tax-free for 2021. So that might be surprise number two for a number of people, is that if they don't decide to make that tax-free like they did last year, then they're going to have an added tax bill that's going to be coming along. And a number of people, from my perspective and my practices, a lot of them didn't have federal income tax withheld on it in the first place. So they might be in for a surprise.
Very unpleasant surprise.
Very unpleasant.
Come April of 2022.
Yep. So I wanted to talk just about a couple things with what the House Ways and Means Committee came out with in regards to their potential tax proposal that they're going to put before the House and then obviously put before Congress. And one of the big ones is, and this probably doesn't affect most of us, probably it does you, Gary, but most of us this wouldn't affect. But they're talking about rolling back the estate tax cap on what you're allowed to exempt from paying estate taxes on. Believe it or not, it is currently at $11.7 million per person. And that was, and I know a lot of people would want to blame President Trump for raising that, but actually it was President Obama. That is sitting at 11.7.
And so what that means is, what does that mean? That means
you get 11.7 and your wife gets 11.7. So you basically can shield almost $23 million from estate taxes upon yours and your wife's demise. They're talking about cutting that back to the old rules, which is half. So it'd be about 5.8 per. But that's still over $11 million between the two of you can avoid paying taxes on.
So let me get this straight. Throughout your life, you pay taxes on the money that you earn. You pay property taxes and you pay taxes on your investments as they go along, unless you got them invested. Then when you die, you pay taxes again.
Well, yeah, but at the present rates, when I got into practice, the lifetime exemption, and you would remember this because you probably were getting into practice right around the same time, which was, for me, was actually a little bit later, but back in the early 1980s, the exemption was $600,000 per person.
I kind of recall that, yeah.
Yep. So 1.2 between you and your spouse. Now it's 23 million.
That's what inflation does for you.
Yeah. Part of the reason why they raised it up is because of the farming industry. There were a lot of farms that were valued after death at an enormous amount of money, but there wasn't cash to be able to pay the estate taxes to be able to, for another generation to inherit those.
And it's not just the farms, but it's family businesses that
Absolutely.
that are devastated by the tax bill when the owner parents die.
Yeah, well, that's actually what President Biden wanted to do. President Biden wanted any inherited property in excess of $1 million. If you made over $450,000 and you inherited property in excess of $1 million, he wanted that to be taxed immediately. So.
Let's not get into
the
politics.
Step up.
Let's get back.
We'll stay out of politics. Okay.
Let's get that glow
So
back
let's
in
talk
there.
about. Let's just talk about a couple things from this. Number one is under President Trump, the corporate income tax rate was dropped quite a bit. It used to be a graduated rate that started at 15% and went up all the way to 35%. He dropped it down to a flat rate of 21%. The House Ways and Means Committee is proposing a 26.5% amount.
Which, if you do the government statistics-wise, that's a 25% increase in taxes from 21 to 26.
Right. Not to get political, but who ends up paying for that?
People who buy stuff, goods, services
Exactly.
from the manufacturers. and
Exactly.
sellers.
The other side of it also is that as President Biden ran on and is following up on, they are talking about raising the highest individual tax rate is going to go up from 37% to 39.6%. So there's going to be a 2.6% raise on that, and the level is going down. So if you're married filing jointly, you used to not get to the 37% until you hit over $650,000. Now you're going to hit it at $450,000. So anything above $450,000, you're going to pay the 39.6%. In addition to that, and this would only apply to you, Gary, anyone who's making in excess of $5 million a year, they are also going to get slapped with an additional 3% surtax.
So let's take pity on our friends from California. They were 39% taxes, plus 3%, plus a 12% California state income tax. That's close to like 56% of their money goes to taxes before they get to take a penny home.
Yep.
Is that fair? I don't know.
Well,
It's your fair share.
Yeah, that's the other thing that did not come up in the plan is what was referred to as SALT, state and local income tax, and that is the deduction. As many people have discovered, under the Trump administration, they made a big modifications to the amount that you're allowed to itemize as deductions. And they capped state and local taxes, property taxes, Michigan income tax, city Detroit taxes. The maximum you can deduct is $10,000.
For all of that combined.
All of that combined. Well, there's many homes here, and even here in the city of Dearborn, that the property taxes alone exceed $10,000 a year. Many, many homes. So that was limited. There's two states actually 3 states that really screamed and hollered about this, and that was California, New Jersey, and New York, because the property taxes are just astronomical there. So the original talk is to uncap it or raise it up to $20,000. But the House Ways and Means Committee has not brought up anything, but stay tuned. I believe they will. Which leads me to another thing that we'll touch base with a lot of our listeners today is that because of the changes in itemized deductions, everybody wants to collect all their little bills, and they come and they visit me and they put all this stuff in front of me, because For years, they've itemized their deductions instead of taking the standard deduction. The standard deduction right now for many individuals, especially seniors, is in excess of $27,000 a year.
You have to have a lot of donations
Right.
to Salvation Army. To
There's
get $27,000.
only, unless you're hanging out at the casinos and winning a lot of money, and you got a lot of losses to take against it, there's only 3 places for you to be able to get your deductions, to be able to get above that 27. I believe it's 27.8 for seniors. And that is your state and local income tax, your SALT. But that's capped at 10. So take 27.8, subtract 10, you're down to 17.8. The next item that you can deduct is possibly your mortgage interest. Well, most seniors don't have paid their house off. But even if you had a small mortgage, let's say your mortgage interest is $5,000. We've now gone from 27.8 to 17.8 minus 5 more. We're down to 12.8. Unless you're giving an awful lot of money away to charity, you're most likely not able to itemize.
So
Stop worrying about gathering all these receipts.
what's it from the CPA who says, I don't need all the work, we'll write off one lump sum. Your tax bill will be cheaper
Right.
from me for your preparation to go on your
Well,
way.
you're just doing a lot of work.
Okay.
And the last thing I want to bring up, because I know we're down to just
We're
the
down our last
couple,
minute or two, yeah.
and it has to do with the itemized deductions. Here's a thing that has been available for many, many years. If you have to going back to our RMDs for IRAs, you are allowed, if you're over 72, you are allowed to make a direct contribution from your IRA to a charity. You don't get a deduction for it, but most of us aren't itemizing anymore. But you don't have to pay income tax on that IRA distribution.
So you meet your RMD requirement, you don't pay tax on it, you save money.
Let's say you give your church, synagogue, or whatever. You normally give them $10,000 a year. You can't itemize anymore. You have an RMD that's $12,000. You take and give that $10,000 directly from your IRA. All you pay taxes on is the $2 that you put in your pocket.
Sounds like a plan.
Yep.
Jerry, you've helped us go through these things, but if people want more information, talk right to the source, how can they reach out to Jerry Assenmacher?
They can reach me. I'm at my office. I'm at 2350 Monroe in Dearborn, in the Dearborn Area Board of Realtors building. You can call me anytime. My phone number is 313-277-5800. Just mention that you saw me on the show, and I'll help you out wherever I can. If it's a quick question you have, we'll be more than happy to try to answer it for you. But quick questions always seem to also have, what about this? What about that?
But if you ask the right question, you get
That's
that
right.
glow back in Jerry's eyes.
Yeah.
You may not see him on the phone, but you're going to know it's there.
Yep.
Jerry Assenmacher and Associates, thank you for coming on the show. We appreciate you being here. Get yourself an advisor, people. There's so much money you can lose by not doing things the correct way. So much money you can make by having a good advisor. I commend you to do it. I'm Gary Gardner. This is KiwaniTalk. See you next time. Bye-bye.